Navigating the inflation conundrum, understanding the impact on purchasing power of investment returns. Introduction. In the ever-evolving landscape of finance, investors grapple with a myriad of factors that can influence the performance of their investment portfolios. Among these, inflation emerges as a formidable force, casting a pervasive shadow over the purchasing power of investment returns. To fathom the intricacies of this economic conundrum, one must unravel the ways in which inflation can erode the real value of returns, leaving investors to navigate a landscape fraught with challenges. Inflation unveiled. Inflation, simply put, is the general increase in prices of goods and services over time, resulting in the decline of the purchasing power of a given currency. While moderate inflation is a natural occurrence in healthy economies, excessive inflation can have detrimental effects on both consumers and investors. Understanding the impact of inflation on the purchasing power of investment returns requires a nuanced exploration of the mechanisms at play. The erosion effect. At its core, the impact of inflation on investment returns can be encapsulated by the erosion effect. As prices rise, the same amount of money buys fewer goods and services, diminishing the real value of returns. Investors who overlook the corrosive nature of inflation may find that seemingly positive nominal returns mask a decline in their actual purchasing power. Consider a scenario where an investor earns a nominal return of 5% on an investment during a period of 3% inflation. On the surface, the nominal return appears favorable. However, when adjusted for inflation, the real return dwindles to a mere 2%, reflecting the true growth in purchasing power. This illustrates the critical importance of accounting for inflation when evaluating the performance of investment returns. Fixed income investments and inflation risk. The impact of inflation is particularly pronounced in the realm of fixed income investments. Bonds, known for their stability and income-generating capabilities, face the challenge of eroding real returns in an inflationary environment. Fixed interest payments from bonds become less valuable in real terms as inflation accelerates. For instance, consider an investor holding a bond with a fixed interest rate of 3%. If inflation climbs to 4%, the real return on the bond turns negative, effectively eroding the purchasing power of the interest income. This inflation risk poses a significant concern for investors heavily reliant on fixed income instruments, necessitating a strategic approach to mitigate the potential erosion of real returns. Equities as a hedge against inflation. While fixed income investments may be vulnerable to the erosive effects of inflation, equities have historically demonstrated resilience in the face of rising prices. Companies with the ability to adjust prices for their goods and services in tandem with inflation can sustain earnings growth, providing a natural hedge against the diminishing purchasing power of currency. Consider a well-established company that can increase the prices of its products in response to inflationary pressures. This ability to pass on increased costs to consumers allows the company to maintain or even enhance its profit margins. As a result, investors in such equities may experience returns that outpace inflation, preserving and potentially increasing their purchasing power over time. Real assets as inflationary safeguards. Investors seeking a more direct shield against inflation often turn to real assets, such as real estate and commodities. These tangible investments have intrinsic value and may appreciate in price alongside inflation, offering a hedge against the eroding effects on purchasing power. For example, during periods of inflation, the value of real estate properties may increase as construction costs and property demand rise. Similarly, commodities like gold, often regarded as a traditional hedge against inflation, may see their prices surge as investors seek refuge in tangible assets. By strategically incorporating real assets into a diversified portfolio, investors can fortify their defenses against the corrosive impact of inflation. Dynamic asset allocation strategies. In the quest to safeguard the purchasing power of investment returns, dynamic asset allocation strategies come to the forefront. Recognizing that different asset classes respond uniquely to inflationary pressures, investors may adopt an approach that adjusts the portfolio mix based on prevailing economic conditions. For instance, during periods of low inflation, fixed income investments may dominate a portfolio for their stability and income generation. As inflation expectations rise, a shift towards equities and real assets can provide a proactive defense against the potential erosion of real returns. This adaptive strategy acknowledges the ever-changing nature of economic environments and positions the portfolio to weather the impact of inflation. Conclusion. In the intricate dance between investment returns and inflation, investors must wield a nuanced understanding of the forces at play to navigate the financial landscape successfully. The erosion effect, particularly evident in fixed income investments, underscores the importance of considering inflation in the evaluation of portfolio performance. Equities, real assets, and dynamic asset allocation strategies emerge as potent tools in mitigating the impact of inflation, offering investors the means to preserve and potentially enhance their purchasing power. As the economic landscape continues to evolve, astute investors remain vigilant, recognizing that a comprehensive strategy that accounts for the insidious effects of inflation is paramount in securing long-term financial well-being.